We now have a conceptual exercise that we'd like to talk about, and we'd like to work with you. And this is going to deal with those gift tax rules. They also relate to the related party transactions that were at a loss. If you recall, we had a little bit of fun when we went through the lecture where we said, if you ultimately have a basis of such and such, and then when grandma gives it to you, it's worth less. Remember, you don't know what your basis is going to be. Remember, we did a little fun. We said if you sell it for something way up above, you're going to use grandma's cost. If you sell it for something way down below, you're going to use the fair market value on the day that you acquired it. And if it's anything in between, it's a big fat zero. The other question becomes, what's the basis? And that was a little bit of a trick. If you're going to use grandma's basis, you get to use the holding period that she had. If you're using the fair value, you have to start with yours. Didn't we say that as well? So be aware, we want to take a look at some of these exercises. Great little story coming up for you. All right, we've got the following. We have 5 years ago, in March, Molly purchased some land because she had always dreamed of being a farmer. Well, in May of last year, Molly got tired of farming and gave the land to her brother Mike. At the time of the gift, the adjusted basis of the land was 60 and the fair market value was 50. Gift at a lower amount. This is where we had those little hand gestures. If we sell it for something over 60, we'll use that basis. If we sell it for below 50, we're going to use that basis for losses. On June 30th of the current year, Mike got tired of farming and decided to sell the land for $45,000. So, in this case, which basis does he use? Does he use the original basis that Molly had of 60? No. That would only be if he sold it for above that price. Will he use the basis of 50? Yes. For anything below 50, he'll use the 50 to determine his loss. So therefore, he will use the 50 to determine the loss. And therefore, because the fair value at the date was used in calculating it, Mike's holding period does not include Molly's. So therefore, his holding period started when he got it and will not include Molly's for determining that $5,000 loss, whether it's long or short term.